Greetings, everyone. I'm David Darst, here to give you a recap of the fourth quarter of 2023 as of late January 2024. The fourth quarter was loaded with a lot of interesting easing inflation data, continued artificial intelligence enthusiasm, which was a big driver of liquid equity prices, the Magnificent Seven, throughout the year. The expectations of the Federal Reserve being finished with its interest rate increases. The last interest rate increase they had was July 26th, as you know. On the December 13th Federal Open Market Committee meeting, basically no change, which continued several meetings in a row of no change. So this began to build enthusiasm for both stocks and bonds as we went through the final 3 months of the year. October for the S&P 500 was down 2.2%, but then November up 8.9%, December up 4.4%, and for the full year, 24.2% gain for the S&P 500, and that, as you know, follows a 19.4% loss for the S&P 500 in 2022. NASDAQ was even more powerful. October was minus 2.8%, then November up 10.7%, December up 5.5%, and NASDAQ finished the year up 43.9%, and that's after the 33.1% decline in 2022. Finally, the Russell 2000, which is the small and mid-cap companies, as you know, the bread and butter of the U.S. economy, much less globally exposed than the S&P 500. For October, they were down 6.9%, that index. But here comes November, up 8.8%, and December up 12.1%. So they ended up the year up 15.1% for the year 2023, after 2022 being down 29.6%. Gold was up 7.3% in October, up 2.7% in November, up 1.2% in December, up 11.3%, again on the expectations of falling interest rates for the year 2023, after a modest decline of 0.4% in 2022. This extended further into the bond markets. The two-year Treasury rose 4 basis points in the month of October. And as you know, the two-year basically is a reflective of the Fed's monetary policy, very importantly. It was down. It declined 34 basis points in November, another 50 basis points in December, to close the year at 4.23% after closing the year 2022 at 4.44%. So basically a 19 basis point decline for the two-year Treasury. For the 10-year, up 29 basis points in October, and then down 54 basis points in November, and down 46 basis points in December to close the year, listen to this, at 3.88% compared to 3.88% the previous year. So after a lot of up and down throughout the year, it closed unchanged on December 31st, and as we enter January 1st of 2024 at 3.88%. The 30-year up 31 basis points in October, down 50 basis points in November, and down 52 basis points in December to close at 3.97 compared to 4.03%. I would say the 10-year is reflective of either economic outlook or the inflation outlook, or a combination. And you saw it declining significantly in the quarter. The economic forecast of the World Bank, of the International Monetary Fund, and our own work internally shows that for the world, it's the 2022 number was up 3.5% real GDP growth for the world as a whole globally. For 2023, up 3.0%, and the forecast as of now is 2.9%. So basically, a modest gain, and similar to the 2023 year. For the United States, you're looking at 2.1% in 2022, 2.1% in 2023, and expected slowing to 1.5% in 2024. The Middle East and Central Asia, you're basically looking at 5.6% growth in 2022, 2.0% growth expected to be the final number for 2023, and then 3.4% for this year, 2024. Basically, looking at this in terms of portfolio positioning, we favor credit over equities. We favor credit over equities right now. Yields have risen. You have some attractive opportunities there. We think, secondly, the 60-40 model, which is a traditional asset allocation model, should be altered to include a significant allocation to alternatives, taking a little bit from the equities and taking quite a bit from the 40% traditional to fixed income securities. Within alternatives, we do like liquid credit. That's in the liquid space. But within alternatives, we like private credit and private real estate debt. We also like private equity, especially the secondaries. This is a theme, as you know, we have visited with you about in previous updates. The 5 assumptions right now that we're working with as we complete 2023 and enter 2024 is the Fed is expected to cut interest rates, policy interest rates, 6 times. We're not so sure that it'll be 6 times. We're probably closer to 3 or 4 times this year. Secondly is no economic slowdown. No slowdown into a recession, maybe a mild slowdown, maybe getting close to the 0 growth rate in the second quarter and perhaps in the third quarter of 2024. The earnings are expected to be reasonably solid in the economy. And that would affect, of course, the private equity valuations. And no additional geopolitical, this is one of the things the market is assuming, no additional geopolitical turmoil. It's been up and down throughout 2023. Our view right now and the market's view are basically pricing in no additional extension of geopolitical turmoil. And finally, within the United States, no domestic political chaos. There'll be the normal back and forth. The election, as you know, this year is November the 5th, 2024. Tuesday, November the 5th is the presidential election. And markets are not expecting a lot of political chaos. There'll be a lot of political news. There'll be a lot of back and forth. There'll be a lot of typical political struggling and name calling and all of that. But we've been watching the interest rates, and the interest rates so far are not reflecting a lot of domestic political chaos. As far as the geopolitical outlook, you want to watch the oil price, because that, if it gets way up into the 90s, high 90s, or above 100, that is indicative of much more unsettled conditions geopolitically. With that, we wish everyone a great start to 2024 and look forward to catching up with you very soon.